All right, the stock market, the biggest bubble yet. Now, I know all of you are sitting there going, oh, geez, I got a lot of money in the market. I sure hope it's not a big bubble. Well, I hate to tell you, we're maybe probably in my view, the biggest bubble we've ever been in the stock market. And I'm going to show you why. All right, after a massive pullback, equities have reached their all-time highs. Communication services and information technology, think of the big seven, NVIDIA, Microsoft, the technology sectors. Utilities, interestingly, are number 3, and that probably ties into AI as well. The worst is consumer staples, and you'll understand why the market's concerned about that. But, since 2000, S&P is up 111%, NASDAQ's up 160%. And again, strong gains this year after very strong gains the last 2 years before that. Money printing has created the greatest bubble. What this is looking at from 1955 to today is the value of all public and private equities to GDP. Now, the average over that time duration is 120%. Equities have averaged 120% of what our gross domestic product. Typically, before 1995, it was always below. But as you can see, it has become totally disconnected to the real economy. So, the real economy has grown by 2.9% annually since 2000. The equity markets have produced a 14.5% return. That is a massive bubble because asset values ultimately have to be supported by earnings and cash flow and real economics, and they cannot diverge consistently from the underlying economy. But let's get into more technical analysis. Measuring the value of companies both from a price to book value and a price to sales. Okay, what's book value? So think of a company, it's their net worth. They got $1 billion in assets, call it $700 million in debt. That means their book value is $300 million. And what this is saying, what multiple of that book value, that net worth? Historical range where companies trade at is 3.1%. And this is since 1995. If I take this back longer, it's that historical range is much lower. During the dot-com bubble, which nobody's going to argue the dot-com wasn't a bubble, it got to 4.8%. Where is it today? 5.5 times. That's much bigger than the dot-com bubble. Now another one, price to sales. What's the company's sales? How many more times than their sales is a company's trading at from a value standpoint? Dot-com bubble, 2.1 times. What's it today? 3.4. Now, some people will say, well, why aren't you putting a price to equity ratio, the PE multiple, which are very high, but there's been higher periods. The reason you don't do that is because when do companies trade at their highest PEs? When they're earning the least amount of money. When you're in a recession, PE multiples go way up because a lot of companies aren't earning much money. So PE multiples are a horrible way to look at is a company overvalued or not if over a long duration of time. You can look at a company in the short term and say yes, and are their earnings maximized and all the rest. But trying to do this as a market as a whole over time, it doesn't make sense. Now, what's also come back is just like the craziness of 21, in 20 and 21, when the Fed was just gushing money into the system and all these crazy meme stocks and unprofitable companies were running straight up. Same thing happened again the last 12 months. So this is Goldman Sachs, the blue line, Goldman Sachs non-profitable tech basket versus the S&P 500. As you can see, the S&P 500 has had great returns, 16.4%. Unprofitable companies have gone up 52.1%. I'm just going to tell you, beware of investments that are attached to the AI bubble. But there's a whole lot of other nonsense out there. There's this company called Open Door. I don't know if many of you know it. They trade homes. They've never made a dollar in their life. The home values are going down. This company's stock got down to 55 cents in August, and literally it's at like almost $9 today. Nothing's changed. They just keep losing money. They just reported earnings. But that's the stuff. It's the gamification of our equity markets. All right. Now let's look at market caps. And I'm taking the big ones: Apple, Microsoft, Amazon, Google, Meta, Tesla, and NVIDIA. So let's take a look and see what has happened with the market caps of these companies. Let's start with Apple. Great company, biggest company largely for the last, almost 20 years. Apple's market cap was below $1 trillion. In 2018, late 18, they hit $1 trillion. Everybody's, my God, we have a company worth $1 trillion. By the way, just so you all know, our brains, they say human brains really can't process how big $1 trillion is. We throw the word out there, but when you understand the scale and how big $1 trillion is, it's enormous beyond enormous. So Apple got to $1 trillion, it sold back off, and then 2000 went to $2 trillion. And then 22 touched $3 trillion, sold off, and now it's continued to lift. It's a $4 trillion company. It's gone up fourfold since 2018. But then look at Microsoft. Same thing. They didn't get to $1 trillion until 2019. Now they're at $4 trillion in 2025. How about Amazon? They didn't get to $1 trillion until 20. Now they're almost at $3 trillion. How about Google? Same dynamic. How about Meta? Same dynamic. Tesla, a company that's missing all its earnings expectations when there was so much hype and everything's so wonderful, it's at $1.5 trillion. But the best of all is NVIDIA. I know it's busy and you can't see it. It hit $1 trillion halfway through 23. Then in 24, it went to $2 trillion. Then it went to $3 trillion. Then it went to $4 trillion in 25. And now it touched $5 trillion in value. Let me put this in perspective for you. Germany, big country, big economy. Do you know what the market cap, the value of all the companies on Germany's stock exchange? $2 trillion, half the value of NVIDIA. Folks, this is insanity. And I know you're sitting all there with stock in these names, and you have it whether you know it or not. And when these things get cracked, and you heard what I told you, don't come blaming me when you're, God, I can't believe my stock's down 50%. Hey, when you've got some good gains, there's nothing wrong with taking them. All right, let's talk about housing.